OG John AG here. Something's happening over on X that you need to know about. Handles OG John AG, links in the description. That's where the content that doesn't fly on YouTube gets posted. Here's what I need from you. Drop OG John AG with your gold price prediction for February 15th. Where do you think we're headed? This helps me gauge where this community stands and what analysis you need most. Let me lay this out clearly. Silver closed at $131.41 on the Shanghai Gold Exchange. That's a 4% single-day surge. Gold hit a new all-time high of $5,344.70 on COMEX futures. Mainstream financial media is finally starting to notice. The Shanghai Futures Exchange saw silver up 3% to $130.95. Gold up 3.58% to $5,316.26. Physical inventories on the SHFE, 35.9 metric tons withdrawn Wednesday alone. Total silver inventories now down to just 508 metric tons. That's 16,344,000 ounces. And here's the part that made me sit up at 3 in the morning when I saw it. The SGE massively hiked silver margins to 60%. Let that sink in for a second. 60% margins on silver in Shanghai, while inventories are collapsing and prices are exploding. If you don't understand what that means, stay with me, because this is the kind of move that signals exactly what we've been discussing for years. The physical market is starting to override the paper pricing mechanism, and the people who control the physical flows are responding in ways that tell you everything you need to know about what's happening beneath the surface. According to the data released by the Shanghai Futures Exchange, silver inventories have been in a relentless drawdown. We're talking about a total SHFE silver inventory that has declined to just 508 metric tons. To put that in perspective, that's roughly 16.3 million ounces. For context, global industrial demand for silver in 2025 alone was estimated at over 580 million ounces by the Silver Institute. What's sitting in Shanghai right now represents about 2.8% of annual industrial consumption. 2.8%. And withdrawals are accelerating. 35.9 metric tons pulled Wednesday. That's not restocking. That's not arbitrage normalization. That's physical offtake in an environment where premiums are already elevated and the exchange is raising margins to choke off speculative leverage. Now let's connect this to what's happening on COMEX. Gold futures hit a new all-time high overnight, 5,344.70. Mainstream outlets are covering it because it's a clean headline. What they're not covering is the technical and structural setup that got us here. Gold has been in a sustained uptrend since late 2024, driven by central bank buying, particularly out of China, Russia, and several BRICS-aligned nations, persistent dollar debasement concerns, and geopolitical fragmentation. The chart structure on gold is textbook: higher lows, higher highs, momentum confirming price, volume supporting rallies. We're above the Ichimoku cloud on every meaningful time frame, RSI holding above 50 on pullbacks, MACD bullishly crossed. This is not a speculative mania. This is a structural repricing of monetary metals in an environment where fiat currency confidence is eroding and central banks are diversifying reserves away from dollar-denominated assets. But here's where it gets interesting. Silver is outpacing the stock market on a relative performance basis. The chart of silver versus the S&P 500, which you can see in the data circulating, shows silver in a decisive breakout from a multi-year consolidation that started in 2011. We spent over a decade in a brutal sideways-to-down grind while industrial demand was building, mine supply was plateauing, and the paper markets kept silver suppressed through concentrated short positioning. That ratio bottomed hard and is now in a vertical recovery phase. Silver is outperforming equities. Yet, and this is critical, silver is still nowhere near its all-time highs. The nominal high from April 2011 was around $49 on COMEX. Adjusted for real inflation, using the methodologies outlined in works like When Money Dies by Adam Ferguson or the monetary debasement frameworks in Jim Rickards' Currency Wars, that number is closer to $70 to $80 in today's purchasing power. We're at 113 to 115 on COMEX as of late January 2026. Shanghai is pricing it higher, 131.41, but that's RMB per kilogram. Convert that and you're still seeing premiums to COMEX, but we're nowhere near inflation-adjusted all-time highs. That gap is the opportunity and the tension. So why is Shanghai hiking margins to 60% right now? Let's think this through. Margin requirements are a risk management tool. Exchanges raise margins when they perceive excessive volatility, when they want to slow down speculative positioning, or when they're concerned about delivery stress. The SGE and SHFE are not COMEX. They are physically settled exchanges. When you take delivery on the SHFE, you are pulling physical metal out of registered vaults. The exchange has a vested interest in maintaining orderly markets and ensuring that there is enough physical inventory to meet delivery obligations. When inventories drop to 508 metric tons, and you're seeing sustained withdrawals, 35.9 metric tons in a single day, the exchange is looking at a scenario where speculative longs could overwhelm available physical supply. A 60% margin requirement is draconian. Normally, commodity margins on exchanges like COMEX or SHFE run anywhere from 5 to 15% depending on volatility. 60% means you need to put up 60 cents of capital for every dollar of notional exposure. That effectively kills leverage. If you're a speculative trader running leverage, you're either forced to close positions or post significantly more collateral. The intent here is clear. The SGE is trying to cool off speculative demand because the physical market cannot support the paper positioning at current inventory levels. This is not a sign of weakness in the silver bull case. This is confirmation that the physical shortage we've been tracking is real, it's intensifying, and the people managing the physical flows are taking emergency measures to prevent a delivery crisis. Let's talk about what drives that physical tightness. Solar panel installations globally are projected to exceed 400 gigawatts of new capacity annually through 2030, according to the International Energy Agency. Each gigawatt of solar capacity requires roughly 25 to 30 metric tons of silver in photovoltaic cells. That alone is 10,000 to 12,000 metric tons per year, over 320 million ounces, just from solar. Add electric vehicles, each requiring half to 1 ounce of silver in electrical components and batteries. Global EV sales are expected to hit 20 million units in 2026. That's 10 to 20 million ounces right there. Then you have 5G infrastructure, AI data centers. Each hyperscale data center can require thousands of ounces of silver in circuitry and cooling systems, defense applications, electronics, and traditional industrial uses. Meanwhile, global mine production of silver has been essentially flat to slightly declining since 2015. According to the USGS, primary silver mine output peaked and has struggled to grow due to declining ore grades, underinvestment during the long bear market, and the fact that roughly 70% of silver is a byproduct of zinc, lead, copper, and gold mining. When those base metals aren't economical to mine, silver supply contracts. China is the world's largest importer and consumer of silver. According to data from the Silver Institute, China accounts for roughly 1/3 of global industrial silver demand. They are also strategically positioning in metals as part of their broader de-dollarization strategy. We've seen Chinese export controls on critical minerals like gallium, germanium, and rare earths. We've seen them build strategic reserves in copper, aluminum, and other industrial commodities. Silver fits squarely into that playbook. It's a dual-use metal, industrial and monetary. If you're China and you're preparing for a world where the dollar's role diminishes, where supply chains fragment along geopolitical lines, and where technological competition with the West intensifies, you accumulate silver. The drawdown in SHFE inventories is not random. It's consistent with strategic offtake by entities that understand the long-term supply-demand imbalance. Now let's pivot to the macro environment. Gold at new all-time highs is a signal that something is broken in the confident structure of fiat currency. Central banks globally have been net buyers of gold for 15 consecutive years, according to the World Gold Council. In 2024 alone, central banks added over 1,000 metric tons to reserves. That pace has not slowed in 2025. Russia, China, India, Turkey, Poland, these are not speculative buyers. These are sovereign entities diversifying away from dollar reserves. The narrative that gold pays no yield used to be the reflexive dismissal from mainstream finance. But when real interest rates, nominal rates minus actual inflation, are negative or barely positive, and when the risk of currency devaluation is rising due to unprecedented debt levels and continued money printing, gold's no yield becomes irrelevant. It's a store of value in a world where paper assets are being debased. Silver follows gold, but with a twist. Silver has the monetary history. It was money for thousands of years, but it also has the industrial demand that gold lacks. Gold is largely inert in industrial applications. Silver is consumed. It's used in applications where it cannot easily be substituted. Conductivity, reflectivity, antibacterial properties. That dual demand profile means silver can outperform gold in a monetary crisis with an industrial boom. And that's exactly the setup we have. We're in an energy transition that requires massive amounts of silver. We're in a technological arms race, AI, quantum computing, advanced semiconductors, that requires silver. We're in a geopolitical environment where nations are hoarding strategic resources. And we're in a monetary environment where central banks are buying gold, and investors are waking up to the fact that silver is undervalued relative to its fundamentals. The technical picture on silver supports this thesis. The silver to SPX ratio chart, silver priced in S&P 500 terms, shows a decisive breakout from a 13-year base. That base was formed during a period where silver was ignored, where industrial demand was building quietly, where paper shorts on COMEX kept a lid on price. The breakout in late 2024 into early 2026 is not a false move. Volume is confirming. The move is broad-based across exchanges: COMEX, LBMA, SHFE, SGE. We're seeing backwardation episodes, periods where the spot price exceeds the futures price, which is abnormal for silver and indicates physical tightness. The COT report from the CFTC, which tracks positioning on COMEX, has shown a steady reduction in the concentrated short positions held by a small number of bullion banks over the past 18 months. That unwinding of shorts removes a structural headwind that suppressed silver for years. When you combine reduced paper supply, fewer shorts, with increased physical demand and declining inventories, you get the price action we're seeing now. But let's be balanced here. There are reasons this rally could stall or consolidate. First, a 60% margin hike on the SGE is designed to slow down speculative momentum. It will work in the short term. Traders who were running leverage will be forced to reduce positions. That could lead to profit-taking and a pullback in Shanghai prices, which could ripple back to COMEX through arbitrage. Second, if global growth slows, recession fears, credit contraction, industrial demand for silver could soften temporarily. Silver is more economically sensitive than gold because of its industrial component. In a deflationary scare, silver can get hit harder than gold. Third, central banks do not buy silver the way they buy gold. Silver lacks the same level of institutional support. If we see a broad risk-off move in markets, equities down, bonds bid, dollar strength, silver could correct alongside other commodities. Fourth, the U.S. Federal Reserve's policy stance matters. If the Fed pivots to a more hawkish stance, if real yields rise, if the dollar strengthens significantly, that puts pressure on all commodities priced in dollars, including silver. And fifth, geopolitical risk cuts both ways. If tensions ease, trade deals, diplomatic breakthroughs, the flight to safety bid in metals could diminish. These are real risks. This is not a one-way trade. Markets never are. But here's the counterpoint, and this is where the news from the last 24 hours matters. The margin hike and the inventory drawdown in Shanghai are not bearish signals for the long-term thesis. They are confirmation that the physical market is under stress. A margin hike is a supply-side response to excess demand. It's the exchange saying, we cannot allow open interest to grow at current inventory levels because we might not be able to deliver. That's bullish for physical holders. If you own physical silver, you are holding the asset that the market is scrambling to secure. The paper market can manipulate price in the short term, but it cannot manufacture physical metal. The industrial users, solar companies, electronics manufacturers, defense contractors, they need the physical. They will pay up. The arbitrage between COMEX and Shanghai will widen if physical tightness persists, and that will pull COMEX prices higher over time. Gold at new all-time highs provides a tailwind. When gold is breaking out, it validates the thesis that we are in a monetary metals bull market. Silver has historically lagged gold at the start of these cycles and then outperformed later as the move matures, and industrial demand layers on top of monetary demand. We saw this in the 2000 to 2011 cycle. Gold led from 2001 to 2008, silver started catching up in 2009, and then silver went parabolic from late 2010 to April 2011, ultimately outperforming gold on a percentage basis. The current setup rhymes. Gold has been leading since 2022. Silver is starting to catch up now. If history is any guide, and as Edwin Lefebvre's Reminiscences of a Stock Operator reminds us, markets are driven by human psychology and patterns repeat, we could be entering the phase where silver begins to outperform. The supply-demand fundamentals have never been this bullish. The Silver Institute's most recent report projects structural deficits continuing through the end of the decade. Mine supply is not responding. Even with higher prices, it takes years to bring new mines online. Existing mines are dealing with declining ore grades. Recycling can help, but silver recycling is inefficient. Much of the silver used in industrial applications is lost or uneconomical to recover. The deficit is real, it's growing, and it's being met by drawdowns in above-ground inventories. The SHFE data showing 508 metric tons remaining is a microcosm of the global picture. We're running down the buffer. At some point the buffer runs out, and price has to rise high enough to either ration demand or incentivize massive new supply. We're not at that price yet. Here's the mid-video reveal that reframes everything. The 60% margin hike by the SGE is not just about controlling speculation. It's about preserving physical inventory for strategic national interests. Think about it. China is in a technological and geopolitical competition with the West. They need silver for their domestic industries: solar, EVs, 5G, defense electronics, semiconductors. If speculative capital, including international capital, is driving up prices and pulling physical out of Chinese vaults, that creates a national security concern. By hiking margins to 60%, the SGE is effectively saying, we're going to make it prohibitively expensive for speculators to play this market, so that the physical stays available for our domestic industrial users. This is economic warfare by other means. China is using exchange policy to control resource flows. And if they're doing it for silver, you better believe they're thinking about it for copper, rare earths, and every other critical material. This has implications beyond just the silver market. It tells you that the era of free and open global commodity markets is fracturing. We're moving into a world where nations hoard strategic resources, where export controls become common, where prices in one jurisdiction can diverge significantly from prices in another because physical flows are restricted. The arbitrage between COMEX and Shanghai could widen dramatically if China continues to restrict outflows or if they impose export controls on silver. And if that happens, Western buyers, industrial users, investment funds, retail stackers will be competing for a shrinking pool of available metal, and COMEX prices will have to rise to reflect that scarcity. Gold's breakout to $5,344 is not just a number, it's a psychological break. It signals to the broader market that the 20-year consolidation in real terms is over, and we're entering a new regime for monetary metals. Silver at $131 in Shanghai, even accounting for currency conversion, is trading at a premium to COMEX. That premium is a market signal. It's telling you where the physical demand is. It's telling you that the paper price on COMEX is lagging the physical reality. And as more people wake up to that disconnect, as more industrial buyers realize they need to secure long-term supply, as more investors look at the chart and see silver outperforming the S&P 500 for the first time in over a decade, the capital flows will shift. We are at an inflection point. The margin hike in Shanghai might cause a short-term consolidation. It might shake out some weak hands. But the underlying forces, the supply deficit, the industrial demand growth, the geopolitical fragmentation, the monetary debasement, the central bank buying of gold pulling silver higher, those forces are not going away. They're intensifying. The fact that the SGE felt compelled to take such a drastic step, 60% margins, tells you how serious the physical tightness is. And if the physical market is that tight now, what happens when the next wave of industrial demand hits? What happens when the next geopolitical shock drives safe haven flows into metals? What happens when COMEX starts seeing delivery stress because the ARBs can't get physical out of London or Shanghai? The endgame here is not complicated. Either price has to rise high enough to ration demand, or supply has to increase dramatically, or both. Supply is not increasing in the near term. It can't. The mines don't exist. The investment hasn't been made, so price has to do the work. And we're in the early stages of that repricing. Silver is still 60% below its inflation-adjusted all-time high. Gold just broke to new nominal highs, but is also below its inflation-adjusted peak from 1980 if you use realistic inflation measures. There is room to run. And the fact that we're seeing aggressive policy responses from exchanges, that we're seeing inventory drawdowns, that we're seeing premiums and backwardation, these are all signs that the market is repricing from the bottom up, from the physical layer to the paper layer, and that process is accelerating. Now, what does this mean for holders and traders? If you're holding physical silver, this is validation. You're holding the asset that industrial users need, that speculators are being priced out of, that exchanges are scrambling to manage. You don't need to do anything except hold and wait for price to reflect physical reality. If you're trading, the volatility is going to increase. A 60% margin hike in Shanghai could lead to short-term selling pressure as leveraged positions get liquidated. That could create a pullback on COMEX. But those pullbacks, if they hold above key technical levels, $31 on COMEX, support at the 50-day moving average, are buying opportunities. The trend is up. The fundamentals are bullish. The technicals are confirming. The geopolitical backdrop is supportive. The macro environment is favorable. If you're thinking about entering, do your homework. Understand that this is a volatile asset. Understand that short-term moves can be sharp. Understand that this is not a get-rich-quick scheme. This is a multi-year structural repricing of an undervalued, supply-constrained, industrially critical, monetarily relevant metal. You need to be prepared for volatility. You need to have conviction in the thesis. You need to have a plan for how much exposure makes sense for your risk tolerance, and you need to think in terms of years, not weeks. The broader lesson here